The stock market is a realm of endless possibilities, where fortunes are made and lost with every tick of the clock. Amidst the complex world of technical analysis, one tool stands out for its uncanny ability to predict price reversals and identify potential trading opportunities. Fibonacci retracement. This powerful tool, rooted in ancient mathematical principles, has captivated traders for generations with its remarkable accuracy in forecasting market trends. Like the intricate spiral patterns found in seashells, galaxies, and even the human body, Fibonacci ratios permeate the very fabric of our universe. In the realm of stock trading, Fibonacci retracement levels act as invisible guideposts, marking potential levels of support and resistance where prices are likely to reverse. These levels are not arbitrary, but are derived from the mathematical relationships inherent in the Fibonacci sequence. By understanding and applying these retracement levels, traders can gain valuable insights into the underlying rhythm of the market, enabling them to make more informed trading decisions. The foundation of Fibonacci retracement lies in the concept of the golden ratio, often represented by the Greek letter phi, Fef. This enigmatic number, approximately equal to 1.618, is derived from the Fibonacci sequence and possesses unique mathematical properties that have fascinated mathematicians, artists, and architects for centuries. The golden ratio is found throughout nature, from the arrangement of petals in a flower to the spiral arms of a galaxy, suggesting a fundamental harmony underlying the universe. In financial markets, the golden ratio manifests through Fibonacci retracement levels. These levels are calculated by dividing vertical distances on a stock chart by the key Fibonacci ratios 23.6%, 38.2%, 50%, 61.8%, and 100%. The 61.8% retracement level, often referred to as the golden retracement, holds particular significance for traders. Traders closely watch for price action around these Fibonacci levels, as they can provide valuable clues about the future direction of a stock's price movement. Plotting Fibonacci. Retracement levels on a stock chart is a straightforward process that can be accomplished using most charting software. The first step is to identify a significant price swing, which could be a sharp upward movement or uptrend, or a downward movement or downtrend. Once you have identified the swing high and swing low of this move, you can use your charting tool to draw a Fibonacci retracement tool connecting these 2 points. For an uptrend, you would draw the Fibonacci tool from the swing low to the swing high. Conversely, for a downtrend, you would draw the tool from the swing high to the swing low to identify potential support levels. These retracement levels act as potential support and resistance zones. To illustrate the practical application of Fibonacci retracement, let's delve into real-time examples from the Nifty 50 index, focusing on 2 prominent stocks, Reliance Industries and Infosys. By analyzing historical price data and observing how these stocks have interacted with Fibonacci levels in the past, traders can gain valuable insights into potential future price movements. It's important to note that while Fibonacci retracement is a powerful tool, it is not foolproof. Section 5. Decoding the support and resistance zones, where the smart money bets. Fibonacci retracement levels gain their significance from their ability to act as support and resistance zones in the stock market. Support levels. In an uptrend, Fibonacci retracement levels act as potential support levels. As the price of a stock retraces downwards or corrects, buyers tend to step in around these levels, anticipating a resumption of the upward trend. Resistance levels. Conversely, in a downtrend, Fibonacci retracement levels act as potential resistance levels. As the price of a stock attempts to rally upwards or bear market rally, sellers may emerge around these levels, pushing the price back down. By identifying and understanding these support and resistance zones, traders can make more informed decisions about entry and exit points for their trades. Section 6. The power of convergence, blending Fibonacci with RSI and MACD indicators. While Fibonacci retracement is a potent tool on its own, its effectiveness is amplified when combined with other technical indicators. By blending Fibonacci levels with momentum oscillators like the Relative Strength Index, or RSI, and the Moving Average Convergence Divergence, or MACD, traders can create a powerful synergy of signals, enhancing their trading strategies. The RSI is a momentum oscillator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of prices. By integrating these indicators, traders can filter out false signals, confirm potential trading opportunities, and refine their entry and exit points. This combination can provide a more comprehensive view of market conditions, leading to better trading decisions. Section 7. Beyond the charts, the indispensable role of fundamental analysis. While technical analysis tools like Fibonacci retracement provide valuable insights into price movements, it's crucial to remember that they are just one piece of the puzzle. To make truly informed trading decisions, traders must go beyond the charts and delve into the world of fundamental analysis. Fundamental analysis focuses on evaluating the intrinsic value of a company by examining its financial statements, industry trends, management team, competitive landscape, and overall economic outlook. Strong fundamentals provide a solid foundation for long-term stock price appreciation. Key fundamental factors: earnings growth. Companies with consistent earnings growth are more likely to see their stock prices rise over time. Revenue growth. Increasing revenues indicate strong demand for a company's products or services. Profit margins. High profit margins suggest efficient operations and pricing power. By combining technical analysis with fundamental analysis, traders can develop a holistic view of the market, making more informed and well-rounded trading decisions. Section 8. Mastering the art of prudent trading. Tips for navigating market volatility. The stock market is a dynamic and often unpredictable environment, characterized by periods of both calm and volatility. To navigate these choppy waters, traders must adopt prudent trading practices. 1. Define your risk tolerance. Determine the amount of potential loss you are comfortable with. 2. Set stop-loss orders, essential for limiting potential losses. 3. Diversify your portfolio. Mitigate risk and enhance potential returns. 4. Start small and scale up. Begin with a small amount of capital. 5. Avoid emotional trading. Emotional trading is a recipe for disaster. 6. Stay informed. Stay updated on market trends and news. By following these tips, traders can better manage risk and navigate market volatility. Section 9. The psychology of trading. Keeping your emotions in check. Trading psychology plays a pivotal role in determining success or failure in the stock market. Emotions like fear and greed can lead to impulsive decisions and costly mistakes. Mastering trading psychology is as crucial as understanding technical analysis. Fear can paralyze traders, preventing calculated risks. Greed can lead to overconfidence and excessive risk-taking. Have a trading plan. It guides your decisions and helps you stay disciplined. Set realistic expectations. The stock market is not a get-rich-quick scheme. Take breaks. Continuous trading can lead to fatigue and emotional burnout. Practice patience. Successful trading requires patience and discipline. By managing our emotions, we can make rational decisions and stay true to our trading plans. Section 10. Conclusion. Embracing a holistic approach to stock market success. Mastering the art of stock trading is a journey that requires continuous learning, adaptation, and a deep understanding of both the technical and psychological aspects of the market. Fibonacci retracement, with its ability to identify potential support and resistance levels, serves as a powerful tool in a trader's arsenal. However, it's crucial to remember that no single indicator guarantees success. By combining technical prowess, fundamental insight, risk management, and emotional intelligence, we can embark on a rewarding journey toward achieving our financial goals in the captivating world of stock trading. The stock market is a dynamic and ever-changing landscape, and as traders, we must remain adaptable and constantly seek knowledge.